All right, welcome in. This is the Tuesday not so deep dive episode on Chit Chat Money, the show where we're trying to go over the basics of a company and a stock in about 30 to 45 minutes. We're talking Snap today, otherwise known as Snapchat. One of the most popular messaging and social media companies out there. We're going to go over it. I have to ask Brad, this is something we haven't covered before researching this for the show. Have you known about this company or the stock or researched it at all before this episode?
Yeah, have the app on my phone. Definitely use it sometimes just to stay in touch with friends. I have not really explored the company all that deeply. This was the closest look I've taken at it to date.
All right, so this should be a fun one, and we're going to talk about them. But first, Ryan, do you want to talk about the special promo we have the next 2 months with Seven Investing? Talk about the discount they're giving.
That's right. This is the Christmas
holiday,
the holiday blowout deal of the year. But anyway, Simon messaged us earlier and said, basically we're giving out discounts on the yearly. So if you want to try to talk about that, and yeah, it's the yearly is already discounted, but we're giving you $50 off the yearly. And so I went ahead, ran the numbers. Typically $49 a month, but if you did that for 12 months, it'd be $588. Their annual is $399 typically. Although if you use code Chit Chat, you get it at $349, $50 off. You're welcome. This is our favor to you, and it's going to be a favor for yourself. Get yourself a nice Christmas gift that's going to be an investment.
And what service is this? You may want to mention.
Yeah, it's Seven Investing. You get 7 picks from their advisors. It's an awesome team. We've had basically everyone on the show, I think minus Dana. And it's been a pleasure. You can go through, read their reports. We've talked about it all the time. And I guess now that I'm saying this will be coming out a day after the new Rex.
Exactly. So perfect timing to get started. 7 Recs per month, great research reports, updated them. It's fantastic. All right. And then let's talk about our advertiser for the Tuesday episode. It is Potential Multi-Baggers. The aim of Potential Multi-Baggers is to find stocks that can go up 10x over the next 10 years or compound at 26% per year. And so far, from what they've given us, their track record is even better than that. So they've even beat this high hurdle rate. And that's because they pick stuff at like Shopify at $77 a share, C Limited at $54 a share, Cloudflare at $39 a share, et cetera. Great service. It's a concentrated basket or a semi-concentrated basket. It's not as wide range of companies, but within that, if this is your cup of tea, if these are the type of companies that you like, the detail and the reporting is very in-depth. It's awesome. And if you can really understand a company wholeheartedly, like from the beginning to end, the history, all that stuff. And Chris, who runs it with a team of other analysts, gives constant updates on what the companies are doing. If there's any big news, stock price movements, whatever, he'll keep you updated on that. It's like a community. So if you want to become a multi, you can go to Seeking Alpha and look for From Growth to Value, Google it, or go to @FromValue with no capitalizations on Twitter. All right, Ryan, do you want to introduce Snap?
Yeah, so Snapchat is a mobile-only messaging and social media app. It's actually kind of hard to describe what they do today in a condensed format because it's really just a mosh posh of different features. But it started out as a messaging app where instead of just traditional text messages, you could send pictures of your face that would disappear after a certain amount of time. You could also go in and do type messages that would disappear as well. But then they also moved into stories where you could share something with all of your contacts at once. I'm pretty sure most people are familiar with stories, but it was kind of commoditized by all the other social media platforms afterward. But today it's a lot more. And I would kind of describe it as it feels like a digital magazine plus messaging features. And so as for the different features, I'll kind of go through some of them. They've got maps. So you have a Bitmoji is what they call it, which is basically like a character. Think of it almost as like your me from the Wii's. I don't know if you remember that back in 2008.
Oh, those still exist. They're still on Nintendo.
Yeah, they still. It feels like a me character, but it's on Snapchat, and you can choose to share your location so people can see each other's location, where friends are at, stuff like that. That also has hotspots, so you can see where a lot of people are at once. And then there's AR tools. So this is sort of I guess there's advertising potential in it, but it's more of trying to alter your face in funny ways. Basically, you can add like a Pinocchio nose to yourself. So they kind of have a bunch of those tools, and then there's subscriptions. So this is like this is where I get kind of the magazine reference, which is there's like ESPN stories. So say you want to watch a recap of Sunday football, you can go watch the ESPN story for a subscription. And then there's Discover, which is people that are trying to promote themselves, be influencer type Snapchatters. And I think they're promoting themselves by paying for it. And then the last one is Spotlight. So this is basically their TikTok like solution. It's kind of like Instagram's Reels, where you kind of just keep swiping up and it's just random videos.
And it's all through one app.
Yeah, it's just this mosh posh of different social media features designed to basically, it feels more like FOMO, like to drive FOMO, and FOMO is fear of missing out for anyone that's not aware. So it's like, oh, this is what I'm doing, you're not, kind of thing. That's kind of the vibe I get it from it. But then also,
that's like all social media, right? Kind of.
Yeah, to some extent. This is more current, like up to date. Like it's not like I would say there's a lot more daily usage than an Instagram, at least from my cohort. Brad, do you have anything else?
I think you guys are both right. It's that really applies to all social media, and maybe Snapchat a little bit more intensely, of just look how happy and amazing and how great of a day I'm having, and kind of showing the world what you want them to see. But I think a lot of social media follows that.
Yeah. Right. And showing on that map they have that people love, where, like I'm at this area, you can see where I'm at. If it's a quote unquote cool spot, people are going to be like, oh, cool, you're there. You want to see that they're on Snapchat. It's a whole game that people play.
Yeah, definitely. And the way they make revenue is pretty intuitive. It's simple, just like any other social media. They generate a bunch of advertising revenue through a bunch of those different features. So I'm not going to belabor any more of the business model, but the history, they actually have a semi-controversial startup story. So apparently Reggie Brown approached Evan Spiegel in 2011. Both were Stanford students at the time, about an idea for a disappearing pictures application. The two of them then brought the idea, or they brought in Bobby Murphy because he was the one that could code. He was the coder. And after a few months of work, they launched an app called Peekaboo. And shortly after that launch, Brown, who was apparently the original one that came up with the idea and talked to Spiegel about it, was ousted from the company. So following his ousting or leaving of the company, it was later relaunched as Snapchat, and it kind of started to take off. But Brown had been gone for a while, and he sent an email to Spiegel about renegotiating his stake. Company lawyers responded and said you had no involvement on the creation of this business. And there might be some gray area in the stories because it's told from two different parties, but they basically were in a legal dispute up until 2014 when the two settled which gave Brown $157 million, and he was credited as one of the founders. So a bit of a Facebook-like story.
Hopefully he doesn't turn into the Winklevi. That would be disappointing.
Yeah. Since then, it's been just a barrage of new features, and the company finally IPO'd in 2017. Outside of the little controversial who's the founder, pretty standard Silicon Valley story.
Yeah, well, and they've kind of been Instagram's AAA team or Instagram's R&D department. So I don't know. I guess they got that going for them. But I'll hit industry and competition. Social media, as we all know, it's a very large industry. Just look at Facebook's market cap. That's kind of the opportunity set people have. And just look at digital media. I mean, you got Google as well, YouTube. They're really competing with just time spent on mobile devices. The TAM is easy to identify, but from a dollar standpoint, it's probably a little less, hard. I guess you kind of got to do some sort of thing with, how much time they're being spent on the app, how many people they have, blah, blah, blah. But their target or audience is really anyone with a smartphone around the world, which is projected to hit 7.5 billion in 2026. So I don't think they have any risk of market saturation. But again, you kind of have to think with Snap, they're not going after the same target audience as a Facebook, who is going after anyone, including people that are, say, like 60, 70 years old, or possibly even older, where Snap is really for people at this point under 30, under 40, stuff like that. Competitors include, and are not limited to, Facebook, Instagram, TikTok, Discord, Reddit, all the other social media companies that we all know. Curiously, though, in the risk factors and competitive things in the annual report or the 10Q that I was reading, They do not list Roblox as a competitor, but I would argue that it's probably their biggest threat in the United States and Western Europe for acquiring new users that are younger, because I think it's either an hour or 2 hours a day that people under like the age of 15 or 14 or something like that spend on Roblox. And that's hours of the day they're not spending on Snap. I think that's their biggest competitor, at least in that, younger cohort.
But they're not competing for ad dollars.
Well, I mean, I don't really think of it in that regard, because it's all about how much time people are spending on Snap, because then the ads will just follow suit. All right, Brad, do you want to hit management and ownership?
Yeah, and just expanding on competition for a second, I totally agree. They compete with everyone who takes away potential screen time from their operations. So kind of to paraphrase Reed Hastings of Netflix, everyone trying to attract our eyeballs to a screen is less and less opportunity we have to monetize in our own way, and could be thought of as competition. But moving on to management and ownership, pretty interesting. So Evan Spiegel is the co-founder and CEO. Ryan got into a little bit of the drama, but he was so his resume. He was a Red Bull and Intuit intern, and then he became the founder of Snapchat at the ripe age of 21. So and then kind of just pairing that with Zuckerberg and social media and the Winklevoss twins, it really does seem a little bit. There are a lot of similarities to draw between the founding stories, but not a lot of other things to say about Evan Spiegel. 82% Glassdoor rating. There's a lot of reviews, so that's a pretty legitimate rating. Some random workplace culture awards over the last 10 years, but really nothing.
Oh, huge! That's huge. Workplace
culture
awards.
Else
week. Yeah.
Right. Great places to work. No, I'm kidding. But that there's not a ton to highlight. But the CTO is the other co-founder that Ryan mentioned, Robert or Bobby Murphy. Another Stanford grad recruited by Spiegel and this other guy out of college, after him and Spiegel together failed in a startup endeavor to kind of give college students prospective college students advice on which university to go to. So that didn't work. And then they made it Peekaboo and then changed the name to Snapchat. So Robert Murphy, actually, he worked for a POS restaurant system for the first few years until Snapchat could pay him. And he even used his paycheck to fund some of the early endeavors, some of the early R&D. So I found that respect to Robert Murphy. He doesn't seem like he comes from a super crazy wealthy family or anything, but he's sinking his hard-earned money into this project. So I'm kind of glad that he's worth so much money now because of that. But the CFO is Derek Anderson. So he's been with the company for 4 years. He started as the VP of Finance. He's been the CFO for 2 years. He was previously the VP of Finance with Amazon and the Senior VP of Finance at Fox Media. Just a quick note, a lot of these leadership team members come from Amazon and come from Fox Media. So I guess two pipelines that Snapchat has really developed over the years. And then from ownership. So I should note that the company does not file proxy statements. I looked all over the investor relations page. There is not a single proxy statement filed since it's gone public. So this data that I have is from December 2020 on their annual filing. It should be pretty accurate, but it could be a little bit off, but it should be mostly accurate. There's 3 classes of shares. So Class A, Class B, Class C. Class C dominates the vast majority of the voting power. So Spiegel has 4.3% of Class A, 25% of Class B, and 53% of Class C shares for 53.1% of the total voting power. Robert Murphy, the other co-founder CTO, he's got 7% of Class A, 46.6% of Class B, and 46.6% of Class C for 46.4% of the total voting power. So together, these two own 99.5% of the combined voting power. So if you are a Snapchat shareholder, what Spiegel and what Murphy say goes. They pretty much have autonomy to do whatever they want to do and to run the company however they want to run the company. That can be seen as a red flag or a strength, depending on how you view management. And I don't have strong feelings on them either way, but just something to keep in mind. All other company higher ups own 0.8% of the Class A shares, which essentially means no voting power. So it really is these two guys running the show. The other interesting thing to note is Tencent owns 44% of the Class B float. Again, very little voting power associated with that class of shares, but they own a large chunk of it. So good to keep in mind.
Yeah, Tencent is interesting. They got a huge portfolio of tech companies in the US, and you'll actually find them on a lot of the wherever you're looking at ownership stuff, you'll find them in a lot of these tech companies like this. I'll hit valuation quick. Market cap, as I was researching, is about $88 billion. Ticker is SNAP. However, it's been a very volatile stock after their recent earnings report. So check up on it. It could be closer to 80, it could be closer to 100 billion, depending on where it's trading. Price to sales is 23.8, and that is trailing. Price to gross profit is 44. I'm using a 54% gross margin there. I'm not using their adjusted number, which I think it's not real. There's no profitability metrics that make sense to use here. Their cash flow, is a pretty fake cash flow number, because I think it's like 300% of it or 400% of it comes from stock-based compensation. So they had I don't know what it is through the first 9 months, like 700 million in stock-based compensation and say something like 200 million in operating cash flow. I'm sure Ryan will get into some of that. And when it's that bad, I kind of tend to discount what the actual cash flow number is. It reminds me of when in the Seinfeld episode, when if anyone watched that, when George pretends to get, he gets a wig. And he's they're like, I thought you were bald. And he's like, no, I was bald. Whatever. But that's how I think when a company kind of purports their either adjusted EBITDA or cash flow number when it's all from stock-based compensation. And then another thing to note, they have around 100 million unvested RSUs and options versus about 1.6 billion shares outstanding. So it's a decent amount. It's not crazy. It seems like their pace has slowed of granting these options and RSUs. It's slowed a bit from the previous years, but they used to have a very bad share dilution. I think since the IPO, the shares outstanding have gone from 1.1 billion to 1.6 billion, but their current pace is a little bit slower. So I think the dilution rate should be a bit not as bad as it has been. All right, Ryan, do you want to hit earnings?
Yeah, and they just reported earnings. So, and it's funny, they usually set the tone for the whole advertising industry. You'll always see these pair trades where if Snap reports good earnings, Facebook will pop, even though it reports a week later. And so, or the inverse as well. If they had bad earnings, Facebook will kind of do the same. But I'll hit some of the trailing 12-month numbers to give more of a holistic view, and then I'll go into Q2 more specifically. They have last 12 months, their revenue is about $3.7 billion. That's up 73% year over year. They have about 55% gross margins in that period. Gross margins has been improving rapidly, I guess, since they've come public. So it was 44% 2 years ago. It's really been quite the impressive kind of trend in that direction. And then they're barely operating cash flow positive trailing 12-month. But Q2, I'll go ahead and say it right before I give all the numbers. It dropped 31% after the report. So I'll kind of talk about why that is. But they reached 306 million daily active users. That's a 23% increase year over year. Revenue grew 57% to 1 billion. But this came in under their guidance. And the headline or the reasoning for that was around the iOS data tracking changes. So this really stole the headline in general for Snap and advertising in general's whole quarter, which was, are they going to be able to adapt to the iOS changes? What does it mean? How does it shake out how does the advertising landscape shake out after the iOS changes? And so that really kind of was the primary reason that the stock tanked after earnings. But I'll keep going. They had 58% gross margins in the quarter. It's a slight improvement from last year. And they had 70 million in operating cash flow, but they spent 300 million on stock-based compensation. So as Brett said, take that cash flow number with a grain of salt.
No, don't take it with a grain of salt. Throw it away. I don't know when it's that bad. But.
I mean, total shares outstanding increased 5% year over year. So the dilution, that is still dilution, but it has come down a bit.
Yeah. All right. You have anything else? Sorry.
No, not really. Free cash flows, there isn't a lot of spend on CapEx, hard CapEx. So free cash flow is pretty much in line with operating cash flow. Yeah.
They have a commitment, I believe, fixed commitments from AWS and Google Cloud to spend 400 million. I don't have the numbers. You can find them in the SEC filings. I don't have the exact numbers, but they have a fixed amount they have to spend with those platforms each year. And that's outsourcing any CapEx they would have to do to their operating expense lines. So really free cash flow and operating cash flow should be similarly in line for a company like this. All right, balance sheet and liquidity. Brad, you want to hit that?
Yeah, and just first on the operating cash flow and the stock-based compensation topic, I think when this happens, it's really important to to kind of look at both adjusted EBITDA and GAAP EBITDA, and then take a look at operating income. Just looking maybe away from the cash flow statement when there's this big of a distortion, and relying more heavily on the income statement and the GAAP income statement to kind of see how far apart these metrics truly are, I think gives a better sense of this specific company's profitability and a lot of others. But for balance sheet and liquidity, we covered dilution pretty well. 60% shareholder dilution roughly since it's gone public. Ryan just told you about 5% year over year this year. So really slowing down, but not slowing down to a halt. They raised $1 billion in convertible senior notes last year to get to roughly $2 billion in cash and equivalents. They have another $1.5 billion in marketable securities. So they're flush with cash. They do have, based on this debt raise, they have $2.25 billion in total net senior notes. Most of this debt comes with a near 0% interest rate, but it has pretty aggressive credit holder conversion rights. So that's why it comes with a 0% conversion rate. For people who kind of follow these debt offerings, I'm thinking of SoFi and Upstart and the debt offerings they just issued, and the formatting is pretty similar, with pretty handsome and pretty favorable conversion rights, which allows you to negotiate a lower rate. But so it's still burning through a lot of cash. It's got about 3-ish years of cash on hand at the current burn rate. So it's got time and things are moving in the right direction. And I'm looking at burn rate adjusted for things like stock-based compensation. I also don't see that 70 million in operating cash flow is real. But yeah, they have cash. They're moving in the right direction. They can get to a point where they don't need to dilute and raise more. But we shall see if that happens.
Yeah, and I'd say the cash flow number, if anyone's confused on that and why we discount it, the $70 million is real. Like, it's real money that they generated. However, when it's offset or when it's all from stock-based compensation, that means that the share count is eventually in the future going to rise because of the stock grants they gave out, or most likely it will rise. And if so, that cash they generated is going to be offset like on a per share basis, because like their free cash flow per share or operating cash flow per share is going to be offset. Ryan, did you have anything to say either? Or?
Yeah, I do, but I'm blanking on it now. So,
all right, well, we'll take the ad break. Ryan will maybe remember, and then we'll get back to the second half of the show. Okay, welcome back in. We jogged Ryan's memory. What do you have as a little tidbit?
We were talking about the cash burn, and it's funny. Like 2 months ago, if you would have said like, "Oh, they only have 3 years of runway to go," you'd have been like, "Who cares? They can just raise again." But suddenly, this is sort of the balance you have to strike. Is when the stock starts coming down, suddenly that doesn't seem so practical, or that doesn't seem like the right thing to do, and the cash burn starts to matter. And
yeah, so, leveraging your share price is almost always risky. Yeah. All right. Anecdotal evidence. This one should be a fun one, I guess. Unfortunately, I'm not in DAU, but it sounds like Ryan and Brad maybe. Brad, what's your anecdotal evidence with Snap?
I think I'm going to create a brand new metric. I think I'm a WAU. I think I'm like a weekly active user. So somewhere between daily and monthly. This is a little personal, but that's okay. We can get personal on the podcast. The only times I really use Snapchat consistently is when I'm using like a dating app, and when that dating app translates into a connection and we move over to Snapchat. So anecdotal evidence, for me, it'd be real. This is kind of out there, but it'd be interesting just based on that anecdotal note that I have for a company like Match Group, to seek out a company like this, not at $100 billion, but maybe when it was trading at $5 to $10 billion, just for kind of horizontal integration, almost funny to think about. But honestly, my friends that I know of in this specific example are the exact same way on when they're using Snapchat. So I thought that was a funny note that our reader or that our listeners would enjoy.
Yeah, it sounds strange, but we probably got a whole bunch of married listeners out there that are like, what are they talking about?
No, Tinder's kind of a competitor almost, right? Kind of for part of the use case.
Snapchat has more users than just, we might not be the target customer base, but the Snapchat serves as kind of like an in-between of dating app and texting, where texting is more serious, dating app is kind of fluff, and then Snapchatting's right in the middle. So it's kind of like the logical next step for those dating apps. But for me, I am a daily active user.
Wow.
Not exactly
Impressive.
for the same reason that Brad reported, but it's more. They introduced a feature called Streaks like 3 years ago, maybe it was 4 years ago, and it's like how many days in a row can you Snapchat a picture of your face with someone? How long have you been talking to them? Days in a row, and it kept a lot of people around.
Can't miss the streak. What are you
can't
gonna
miss
do
the
if you miss the
streak.
streak? World's gonna end. World's gonna end.
I'm picturing older people listening to this, like, what the hell is wrong with these people? But I'm telling you, people want to keep that streak alive, and it's almost like bragging, right? It's like, oh, I have a 1,000-day streak. It kind of just keeps you on the app. I don't use a lot of the other features. I might not be the target customer for some of those.
The ad load's not as heavy for you.
No, but I'll use it. I'll use it for messaging at times. It does in my anecdotal experience. It seems to skew towards a younger audience, the teenagers almost.
Yeah, I think. Gosh, what was the stat they gave out? I think it said in their annual report or something, they have 75% of 29 and younger, or I think it's 12 to 29-year-olds, or maybe it's 16 to 29-year-olds in the United States use Snapchat or DAUs. So, I mean, it's huge. It's within that younger, like Instagram is kind of older. It's within that younger cohort. It seems like Snap's even bigger than Instagram. All anecdotal evidence. I'm not a DAU. I think it's dumb. But usually when I say that, if my first thing is saying that's stupid, like Peloton, Apple products, whatever, for a consumer product, that means it's likely a good investment opportunity. So you kind of got to pull the opposite thing there. But future growth opportunities, Brad, what do you have?
Yeah, we were talking about the augmented reality features that Snapchat's currently working on before the show, and how they're, I think Ryan used the term gimmicky and not super utility enhancing. But I think they do have a lot of money on the balance sheet. They can spend a lot on R&D. And if they get to a point where I can actually, try on a T-shirt from a e-commerce store by looking at my phone on Snapchat, or try on a pair of sunglasses, I think that just unlocks a whole new channel of really compelling e-commerce growth for them that I think I would hope that they're passionately pursuing right now. But I'm not super in the know on this company, so I can't say for sure.
Similar to Instagram, right? Kind of trying to go after that shopping stuff.
Yeah, but almost making it a more personal experience by having that front of camera feature that allows you to actually see the item or the article of clothing on your person, which I think would be a pretty good step up from just browsing search pages on e-commerce sites.
Okay, that makes sense, Ryan.
Yeah, they mentioned that on the Q3, which the conference call, which was they tried it out. I'm blanking on the retailer, but
Ulta, maybe was it Ulta?
Ulta was one of them, but they also did it with like a fashion retailer, but I can't remember who it was. And they I like the idea of those applications. I'm not sure how high conversion really is, because I don't know. Would you trust it if you only saw yourself with like an augmented picture in the clothes, or would you have to
go out and try it? It's got to be good.
So I think today we're far away from that being a reality. Just based on how basic and simple their AR functions are right now. So the technology definitely has to catch up, and I think they need the technology to catch up to grow into their shoes that they're currently sporting right now.
Yeah, for sure. All right, Ryan, what's yours?
So I sat here looking at the future growth opportunities for probably a good 10 minutes before trying to think of anything. That pretty much anything I would have thought of, they've tried or they've done. So they've got, and stuff that I wouldn't have thought of. They got, stories, spotlight, subscriptions, discover mode, maps, the AR tools. I think the most important thing for them to do, and this is, I don't have any metrics on whether or not they've been able to do this very well, is get users away from the old core functions. Find a way to migrate them away from just stories and messaging.
And that's because of the advertising potential isn't good there, right?
No, I mean, it's not a differentiated advertising experience. It's very similar to what you'd get with like an Instagram or Facebook, where it just pops up in between while you're watching stories. It's almost like a TV commercial. Like, you just try to get away from it as quick as you can. Whereas if you can do something that's really unique, like that AR tool, like, oh, I can try on the entire catalog of clothes like through a lens, that'd be sweet. That's very differentiated, but you have to get the users to try those different features out. I don't know how they do that, but that's probably the number one thing I can think of to help them attract more revenue from advertisers. Also, I think they can make better use of maps. It seems like there could be advertising done on that, whether it's like a bar on a Friday night offer discounts. It's got a hot spot right there. You see a whole bunch of people that are there. Use that feature.
Yeah, I don't know why, but it seems like within maps and stuff like that, it's been hard to do advertising. I mean, even Google struggled with that, but I don't know why that is. But that does make sense. All right, I'll hit mine. It's rest of world user growth. So DAUs there are growing very fast. It's at about 130 million now versus only 77 million in Q2 of 2020. So that is a good sign as long as ARPU can follow suit, since it is so low versus North America and even Facebook in that region. So if you look at Snap's ARPU for North America, I forgot to write that down, but I think it's closer to like $8 right now. And Snaps in rest of world, which is everywhere but Europe and North America, is 98 cents. So theoretically, there's a lot of room to expand that. That's part of the Pinterest bull case, I think, as well. And if you look even at Facebook's rest of world ARPU, I don't know if it's exactly the same region. I think that this doesn't include Asia. So it's whatever. You got to look at the definitions yourself. But Facebook's rest of world ARPU is $3.14. So I think Snap still has a lot of room to grow there. If they can get the advertising right, that's probably an easy way for them to expand their revenue. But that's not unlimited. They also got to keep growing the users, which rest of world, that was probably the biggest positive sign I saw was the rest of world DAU growth, because that's going to be huge because they're pretty saturated in North America. All right, highlights and lowlights. Brad, what did you dislike and like about Snap's business?
Yeah, first with highlights. So their penetration within young users is incredible and phenomenal. What was that stat or that statistic you gave, Brett?
I don't know that you can look. They have it on their stuff. It's 75% penetration in North America. People like 18 to 29 or 16 to 29, something like that.
Yeah. I mean, you create a range of numbers within that one scenario, and it's still remarkable any way you shake it. I mean, they clearly have a deep and passionate fan base within young consumers who have more overall LTV to provide than older consumers over the course of their lives. So that's definitely positive. The other thing I'll highlight is we talked about international growth a little bit, and I just saw a headline that they crossed 100 million monthly active users in India. In terms of international expansion, there are very few countries that are more appealing and more compelling, in my view, than finding traction in India. And it's 1.2 or 3 billion, whatever, people who are generally affluent, looking around the rest of the world, or more so affluent than a lot of other places. So that's extremely encouraging to me. And good job, Snapchat. So the low light is TikTok. So TikTok really kind of forced me to change the way I view social media platforms. The way they just raked in 1 billion users in such a short period of time made me think of social media platforms in a little bit more MySpacey than maybe just assuming that product innovation and improvement is going to automatically keep you relevant forever. So somebody like TikTok stepping in and just dominating things, I think not only does that create a whole new competitive force in the social media market, but it also makes me think that the barriers to entry aren't maybe as high as I thought they were originally, in terms of they have a lot of people on their platform, so they'll always have a lot of people on their platform. So that made me a little bit worried. And the other low light that I'll maybe talk about. Awesome growth. They're expected to do 4 billion in sales this year. Fantastic. And they are far from GAAP, not adjusted, but GAAP profitability. So this kind of makes me think, when does that come? And can this company turn off sales and marketing and keep those users sticky enough to make that gross profit flow down to net income and free cash flow? I don't know if they're capable of that, and they have a lot to prove to show that they're capable of that. So we'll see.
Yeah, it's a risk. They got to keep growing revenue if they're not going to be profitable. I mean, they got to show that these investments are panning out, especially with AR, augmented reality. Ryan, what are your highlights and lowlights?
Highlights, the users stick around, at least from what I've witnessed, and they are pretty innovative in terms of trying new things constantly and pushing new features. They also generate a lot more revenue than I would have guessed. Like if you just told me, if you just told me,
Well,
to go out
versus
just
their market cap, maybe.
Well, I mean, if you would have just shown me the app and then told me to guess, kind of,
Right.
if you gave me the users, showed me the app, and then told me to just throw out a random guess, it would not be as much as they generate today. And part of the reason for that is that this is part of my low light. The app feels too crowded. It's overwhelming, where there's too many features that it's like.
Well, that's what I said earlier. I was like, all those features you listed out, I was like, that's all in one app. Feels like it gets clobbered. You can't find anything.
Exactly. And it feels messy when you're on the app. But that's kind of just my personal opinions of it. And then I'd also say that of all the social media apps, except for Twitter, but Twitter doesn't really count. It's more utility. This has the most trust, consumer trust. Anecdotally, it's like people don't feel if Snapchat releases something new, they don't really care. They think it's more of a gimmick, more fun than like if Facebook does it. There's like this automatic resistance anytime Facebook launches something new. So I think Snapchat kind of has that going for them. The other thing, low light, and this is more pressing than my personal feelings about the app, but I have no idea how lasting the impacts of the iOS changes are going to be or what it's going to take to adapt. I don't know if that creates them or makes them a less attractive advertiser or advertising target. They have the demand, that's great, but I'm curious how effective the advertising has been, what sort of measurement tools, how that's been impacted. And also Q4 is going to be tough because, I mean, I guess this goes for most advertising companies, but they mentioned this in the conference call, which is the supply chain problems mean most retail companies can't fulfill demand, so they're cutting on marketing spend. So
yeah, it felt like an excuse though. That felt like an excuse to me to missing their numbers because they were trying to say like, well, in the conference call they said, well, how much is attributable to iOS and how much is attributable to supply chain? And they said it's majority iOS. So I think they were trying to toss that in there. Maybe I'm being cynical, but I think they might have been trying to toss it in there like, look, supply chains are affecting us. I was like, really? I don't know.
Yeah.
But I mean, theoretically it makes sense, I guess.
I'd also give a low light that they have too many prepared remarks on their conference calls. So
Yeah.
If you could shorten those, that'd be great.
Just write it down. Come on, guys.
Give it to us on like a 5-page document that we can read.
Just read it. Yeah, just read it later. I think everyone's in agreement with that. Yeah, it's way too long. I'll hit my highlights. Pretty simple. User growth in the rest of the world has been very strong. I think the potential for ARPU expansion should let them pretty easily grow, outside the United States, the ARPU there. Lowlights though, and this combination worries me, share dilution, worries about durability of the apps, which Brad went into detail with his lowlights, poor capital allocation decisions, in my opinion. And then it's hard for me to see areas of growth outside of this core stuff. It's like all just advertising that people may describe a platform like this with having quote unquote optionality. I don't really see it with something like Snapchat. But maybe I'm wrong. I don't use it very much. And then on the poor capital allocation decision, they bought something called Wave Optics for $500 million. It's like an AR or something company, some sort of technology within that. They're investing a lot within that. They've been talking about that. They have the spectacles, those things, which were a total bust. I just think that's the ROIC on that, return on invested capital, is going to be tough. I just don't like where they're spending money, but that's just a personal gripe. All right, bull case, Brad, what do you think has to go? What do you think has to happen for this to be a good investment going forward?
Yeah, I think they need to figure out how to do as good of a job with monetization as Facebook currently does. And I say that in sort of a worried way because I don't know if they inundate their product with the kind of ad velocity and ad volume that Facebook does, if it remains a compelling product. So maybe I think I'm going to lump my bull and bear case in together and then let you guys do your bull and bear cases. But bull case is Facebook and their ability to match ARPU internationally, like Brett was talking about, and their ability to find new ways to enhance monetization and enhance cross-selling to translate that large user base that they're building into a fantastic business, because that translation is not automatic. And that leads me into the bear case of Twitter. So Twitter, fantastic product. growing user base, and they have not been able to figure out a way to monetize as effectively as some of these other social platforms. Now, maybe it's just a matter of time, and maybe there's a structural reason preventing them from doing so, or maybe Jack just cares more about Square than Twitter. Probably that one. but yeah, the bear case and the bull case is them morphing into a Facebook or morphing into more of a Twitter in terms of their ability to monetize this impressive user base.
Yeah, the connection to Twitter, like, don't think about it as product at all. It's okay, share dilution, revenue and user growth that's not matching up with profitability, or struggling to match up with true profitability. Snapchat feels a lot more similar to Twitter than Facebook in that regard, which is just gushers cash, and it seems to have good capital allocation decisions. But Ryan, what's your bull case?
I think they have to, for this to be a winning investment, they have to have these ancillary features, these additional things they've pushed recently. So Spotlight, some of these AR tools, they have to be good enough to give advertisers a differentiated experience, and they have to be better than what they are today. I think they have to reach $20 billion at least in revenue. Maybe, yeah, they have to, because right now they're unprofitable, and it seems like it'll stay that way for the foreseeable future. But yeah, I mean, it's a premium valuation, so they have to keep growing. And you saw what happens when growth comes slightly under. I mean,
and it was still over 50%. So if they continue decreasing that, I mean, that's the bear case.
The minimum of the range was 58% growth, and they came in at 57%, and the stock tanked 30. The stock dropped a third of its value.
That's the market right now. Yeah. I mean, my bull case is similar. So we're at an $88 billion market cap, probably closer to 100 billion fully diluted. I think you got to expect, like Ryan said, about 20 billion in revenue with strong gross margin expansion that leads to, true cash flow generation. Because if you think about it, say you have a $100 billion market cap, you have 20 billion in revenue, and say they can achieve 20% free cash flow margins. That's $4 billion in cash flow versus a $100 billion market cap. That's a price to free cash flow of 25, which is about right around the market average right now. But that's where the stock trades right now. So to expect good returns, I think you have to, you have to expect this $20 billion in revenue or whatever. It's just a range around there. But at that time, you have to expect them to be continually growing, which, there's just a lot of add up here. You have to have high expectations, I think, for this stock. Bear case, Brad, you already said yours. Twitter, I think that's a great example. Ryan, what's your bear case?
I don't know. The more I think about it, I'm not sure what the end game is here.
Yes, I don't know what are they
like. What are all these social media apps going to be $1 trillion companies? It doesn't make any sense to me.
Well, we're going to expand the number of hours in the day.
That's what I don't get. Is it's like
I would just look at Roblox and look at the hours spent on that thing for younger people. Look at Discord. Look at the hours spent on that. There's no way they're not taking share from a potential Snapchat. In my case, I just think don't sleep on stuff like that. There's a lot of money going after that stuff.
I think a lot of people idealize what each social media app could be and how much time they could take up in a user's day, when in reality, a lot of it's just used for its core function. And Snapchat, I feel like even with all the new products, it's still just used for stories and messaging. That to me isn't worth the valuation right now.
Unless they can really expand users, right?
Yeah, I suppose. I don't know. The bear case is just that. The expectations right now for what the company could be far exceed the reality. Yeah.
And I tried to tweet out what's the bull case for Snap, and I did not get any serious responses. So for the Twitter followers, you didn't step up there. You made all jokes, which were funny, but I guess not. Yeah. My bear case, very similar. I have durability concerns, poor capital allocation concerns. If you look at we were talking before the show with Brad about the Facebook decision to spend $10 billion a year, either through capital expenditures or operating expenses on the reality labs, the AR, VR stuff. Facebook can do that and probably still generate, I don't know, $300 billion in cash flow over the next 5 to 10 years. So it's not like it's going to kill the business, but for Snap to invest in this stuff, they may never have profits if they're reinvesting in these AR stuff and trying to race against the big tech companies. So I think that's why they're poor capital allocation decisions, because they're never going to have anything materialize from that. And then again, the bear case, if there's a slowdown in revenue growth again over the next few quarters, or if it continues slowing down, I mean, things could get dangerous for the stock. And that's the simple bear case here. All right, let's wrap things up. This one's going long. More or less interested, Brad?
Yeah, I gotta go like a lot less interested. So I think that's the first time I've given that that added word. But yeah, just going back to what you were talking about with Facebook and their plans to reduce operating profits by 10 billion and to sink 34 billion into CapEx next year. And you just look at Snapchat's total liquidity of 3.5 billion. They can't keep up. And Snapchat and Facebook, as this, hopefully for my sake as a Facebook shareholder, as this metaverse vision comes to fruition over the coming years, these two products are going to overlap a lot more. And I don't see, unless Snapchat just has wizards in their C-suites and just better engineers and a better vision and just better. They just have to, the margin for error is so small for them here that I don't really see it as all that compelling, especially when you look at Facebook. And they're multiple and they're not growing at 50%, but they're still growing at 35% at much higher scale with fantastic margins. And even if this metaverse spending fails, they're going to have tens of billions of dollars in liquidity on their balance sheet to lick their wounds and to turn right back around. And the other thing I'll mention with this whole iOS change is that first party data, when you can't lean on Apple for the third party tracking know-how, becomes so much more important. And look across the advertising industry, who has that scale? It's Google, it's Facebook, it's the mega caps for walled gardens, not Snapchat. And within the open internet, it's Trade Desk, not Snapchat. So I mean, there's a lot of other companies in this space, in this really compelling space, that I just see as objectively better investments. Not to harp on Snapchat, but I just don't see it.
Yeah, sorry if there's any Snap shareholders here. Sorry for the harsh words, but I hope take all this hopefully to heart. And if we're wrong, we will be happy to see you make money off this. But Ryan, what are you more or less interested?
I'm less interested. I don't care that. I know Rich Greenfield likes it. I know he probably knows more about it than I do. But I don't care.
The great analyst team at Lightship Partners, great media analysts. Yeah.
Yeah. And I respect him, but I just don't understand. Like, I really don't understand. This is $100 billion business and it doesn't make any sense to me.
Yeah, that's a great way to sum it up. I'm in the same boat. Here's the thing with that. Personally, I think that media companies, digital media companies, which Snapchat's in, they deserve a below market multiple because of the risk of durability. Unless you have defensible IP, like a Disney, like a Nintendo. Well, Nintendo's a special case, like video game publishers. There's a few others out there. Unless you have defensible IP, it's hard for me to say that your position within the market is stable. And that's just the big worry. And that's why I'm less interested with Snap. Yes, they've shown for 5 years that they can operate at this scale, but I just worry about all the competition. There's so much money getting spent for these people's eyeballs, 4 to 8 hours a day that people spend on these things. I mean, you're going to bet on Snap at 25 times sales. I mean, God, that just feels like a terrible bet.
I mean, this is a serious question. Can they all be winners?
No.
They're just.
What is this going to turn into Wall-E?
Yeah, it just doesn't make sense to me.
Yeah, I don't know. All right, well, stock for next week, Ryan.
Okay, so I'm going on the trend of website creation and sort of no code tools. So I'm curious, you guys can pick which one you guys want. Either Shopify, which would be a growth hack, or GoDaddy.
Well, I mean, I want to do Shopify. I like the flashy, fun name.
We'll do Shopify. What if your pick next for Ian? Maybe we can spoil it. Let's say GoDaddy with that one, make it a little theme, or no? Or do you have something else? Possibly. We'll table that one. Let's do Shopify. It's way more fun.
We were asked a question, what we think of like that space with Wix, Squarespace, GoDaddy, Shopify, all those competitors. So I want to sort out sort of the competitive landscape. We own Wix. I guess a little foreshadowing. So we have a dog in that fight.
Yeah, Shopify, one of the best
race.
Yeah, one of the best businesses in the world. I think a lot of people agree with that. All right, that's going to do it for this episode. Thank you all for listening. Remember, we are not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan and I are general partners at Arch Capital. Arch Capital clients may have securities discussed in this podcast. Thank you all for listening. We'll see you next time.